Hello everyone, my name is Satoshi Ido. I'm a technical marketing associate at Alpaca. Thank you for your continued support and requests. We're thrilled to bring you this option tutorial, and we'll keep producing more valuable content in the coming month. If there are any strategy or concept you'd like us to cover, let us know in the comments below. And don't forget to give this video a thumbs up. It helps fellow algo traders discover our content while supporting our channel. Before we get into the specifics, let's take a moment to understand what this strategy involves and why some traders use it. The wheel strategy is a structured approach to option trading that involves selling cash secure puts, and if assigned share, selling cover calls. This process allows traders to systematically engage with the market while managing their stock positions. It follows a cyclical process, and starting with selling puts, potentially taking ownership of shares, and then selling calls against those shares. The strategy requires active management, a clear understanding of trade parameters, and careful risk consideration. If you're not familiar with the option trading using Alpaca's trading API, I highly recommend checking out our previous video where we go over the basic. You can find the link in the comments below. And before we start coding, I'd like to note that we're using Walmart stock, WMT, as an example of an underlying asset. And it should not be considered investment advice. The code assumes a flat interest rate and does not consider dividends and does not consider whether the market is open or closed. And it also does not consider whether you already own the underlying security. The code in this video should only be considered a starting point to creating your option wheel strategy and not a finished strategy. It would require adaptation and testing before being used in a live trading. Also, on expiration date, please be careful that Alpaca enforced 3:15 p.m. Eastern Time cutoff for submitting new orders. For broad-based ETFs such as SPY, QQQ, the cutoff for those submitting orders is 3:30 p.m. Eastern Time. Any orders submitting after this time are automatically rejected. And this early cutoff provides a buffer for before 3:30 p.m. Eastern Time when we begin auto-liquidating expiring positions. For broad-based ETFs, we begin auto-liquidating at 3:45 p.m. Eastern Time to manage risk. Okay, now let's get started coding. First, let's make sure we have the right tools installed. We'll be using Alpaca Trading API for trading and historical data, along with some essential Python libraries. For example, we install Alpaca Py for handling trades, and Pandas NumPy for data processing, and SciPy for option calculations. After we import the necessary libraries, we set up our Alpaca paper trading API credentials. And since we're using a paper trading account, no real money is involved. Make sure you replace these keys with your own from Alpaca's. You can find it on the dashboard. Since Jupyter Notebooks don't fully support async code by default, we use Nest Asyncio to fix that. This let us run asynchronous functions smoothly without issues. We also initialize Alpaca clients for trading, stock data, and option data. These clients will help us fetch stock prices, execute trades, and analyze historical data. After that, let's define some key trade parameters. These settings will help us control risk and automated decision-making when selecting options. These parameters ensure we are trading liquid, high-probability options while staying within our risk limits. We used Alpaca Trading API to fetch the current trading price for Walmart stock, and then we calculate our strike price range based on the stock price and predefined strike range parameters. Finally, we print all our key parameters. We can see from the output that Walmart's current price is around $102 US dollars, and my account buying power is about 475,000 US dollars. Also, there are minimum and maximum expiration dates and strike prices, and etc. Now that we've set up our trading environment and defined key trade parameters, let's move on to an essential part of the wheel strategy implementation, calculating implied volatility in an option Greeks. To make informed decision when selecting cash secure puts and cover calls, we need to evaluate the implied volatility and delta of each option contract at least. Instead of estimating those values manually, we'll use Python functions to compute them using a Black-Scholes model. First, let's talk about implied volatility. Implied volatility represents the market's expectations for future price movement and it plays a key role in option pricing. To calculate implied volatility, we use the Black-Scholes model, which relates an option's price to its strike price, underlying stock price, expiration date, and risk-free interest rate. Since implied volatility isn't directly observable, we need to reverse engineer it using numerical methods. Next, we calculate delta, a key Greek that measures an option's price sensitivity to changes in the stock prices. Delta is especially important for the wheel strategy because it helps us select appropriate strike prices for our short puts and cover calls. Also, it gives us an idea of assignment risk. Higher delta means a greater chance of an option expiring in the money. Now that we set up our trading environment and implementing key option calculations, the next step in executing the wheel strategy is selecting the right underlying stock. Since this strategy involves selling cash secure puts and cover calls, choosing the right stock is crucial. We need a stock that has manageable volatility, enough price movement to generate option premiums, but not so much that it significantly increased assignment risk. To evaluate the volatility, we use the average true range, so-called ATR. So ATR measures a stock average price movement over a period of time, helping traders determine how volatile a stock is. Here's how we calculate ATR for the underlying stock. First, we fetch the last 90 days of historical stock data of Walmart stock using Alpaca trading API. Then we calculate a true range TR, which captures the stock daily price movement. And then we compute the 14-day ATR, averaging the true range over a roll window of day, which is 14 days here. And finally, we use our get ATR for stock function to compute the 14-day ATR over the past 90 days in this example. So this gives us a 1.59, which is relatively elevated compared to historical levels as well as industry average. When using a wheel strategy, you may prefer a lower or moderately volatile market. Here, we will proceed with Walmart stock for now. Now that we've selected the right underlying stock, it's time to move to the first step of the wheel strategy, selling cash secure puts. Cash secure puts allow traders to sell put options with the intention of either collecting a premium or being assigned shares at a predefined price. However, one of the most common mistakes in this strategy is trading stocks you don't actually want to own. So before placing a trade, make sure you're comfortable owning 100 shares of the stock, you have enough capital to buy those shares if assigned, and the put option meets certain liquidity, delta, expiration criteria to align with your strategy. The first function we use here is get put options function, which utilizes Alpaca trading API to fetch put contracts for the selected stock based on a strike price range and an expiration data range. Once we have a list of put options, the next step is to filter them down further using a find short put option function. The purpose of this function is to scan a list of put options and select the best candidate that fits our wheel strategy criteria. It filters options based on several factors, some of which are open interest, option delta, and buying power limits. Let's break down how the function works a little bit. One of the first filters we applied here is checking if the option has a valid open interest. Open interest represents the number of outstanding contracts in the market. If open interest or open interest date is missing, we skip the option. If the option's open interest is below the defined threshold of OI threshold parameters, we also skip it. Next, we fetch the latest bid and ask prices for the option and calculate the midpoint price, which serves as an estimate of a true market value. We need this price to accurately calculate option Greeks, such as a delta here. Once we have the option's price, strike price, and expiration date, we calculated implied volatility as well as its delta using calculated delta function, which we implemented earlier. Delta helps us estimate the probability of the option expiring in the money. For our strategy, we aim for the delta range between negative 0.42 and negative 0.18, which balances the premium collection with assignment risk. Now that we have the delta value, we apply the two final checks. Delta must be within our predefined range, and total contract cost must not exceed our buying power limit. If an option passes all filters, we store its details in a dictionary, including options ID, symbol, strike price, or initial delta, and many more. Once we find a suitable option, we break the loop and return it as a final selection. The find short put option function plays a crucial role in automating the selection process for the wheel strategy. By filtering based on open interest, delta, and buying power, it ensures we're only trading options that align with our strategy risk and reward objectives. And now that we've selected the best put option using the find short put option function, the next step is actually placing the trade. In this section, we'll automate the process of selling a cash secure put using the execute cash secure put function. This function automates the cash secure put trade by following a structured process. First, it retrieves put options for the chosen stock, find a best short put based on the delta and capital limits, and place the market order to sell that put if it meets our criteria and using Alpaca trading API. And lastly, return a success message confirming the trade execution. The first step is to fetch a list of available put options for the selected stock. Using the get put options function, we specify the strike price range and expiration window, which here we specified it as 14 to 35 days to ensure we are looking at the right contract for the wheel strategy. And once we retrieve the options, we check if any contracts are available. If no put options are found, we return a message and stop the process. If options are available, we move forward with selecting the best one. We use the short put option function, which we predefine to filter through the put options and select the most suitable contract. Once the function finds the best put option to sell, we place the market order using Alpaca Trading API. Here we set the order side as a sell, order type as a market, and time enforces day, which means the request is valid for today only. And this ensures that our cash secure put order gets executed immediately at the best available price. After placing the trade, this generates the success message confirming the cash secure put sell. The message includes underlying stock price, delta of the sold put, and strike price, premium received for selling the option, and if no suitable option is found, the function returns a message indicating that no contract met our criteria. To simplify find a best short put option without executing trade, we can run the find short put option function only. The output shows an appropriate put options that meets all the predefined criteria for the cash secure put option strategy. Or to just execute the cash secure put trade, we can run the execute cash secure put function as well. So it executes the position, and you can see that ordered position through the API call, or easily finding it on your Alpaca's dashboard as well. We've sold the cash secure put, And once the stock has been assigned, the next step in the wheel strategy is to sell a covered call. A covered call involves selling a call option against the 100 shares we now own. This allows us to potentially generate additional income while managing upside risk. Before we place a trade, we need to ensure the call option meets specific criteria, which include delta, upper Bollinger Bands, and open interest volume threshold. To align with the cash secure put, we must use multiple functions to make sure we select an appropriate call option. To be able to fetch call options for the stock, we define a get call options function just like we did for the get put options. It mainly checks two things: strike price. The call strike price must be above our cash secure put strike price. And expiration date. We select the options expiring within 14 to 35 days. This ensures we are trading liquid near-term options that align with our strategy. To determine the lowest strike price of a call option to prevent unnecessary net loss, we use the upper Bollinger Band. We compute the Bollinger Bands in using three steps. First, calculate a simple moving average, which is the average closing price over the last 20 days in these examples, and calculate the standard deviation, which measures the price variability over the same period. And then calculate upper Bollinger Band from it, which we calculate with 2 sigma, in other words, 2 standard deviations. This way, we extract the latest upper Bollinger Band to determine the minimum strike price for our cover call. Before selling a cover call, we must confirm we have at least 100 shares of the stock in a portfolio for the specific strategy. We built a has sufficient shares function to confirm if the short call option is covered. These functions allow us to fetch our current holdings using Alpaca trading API method. If we don't have enough shares, the function returns an error, preventing us from placing an invalid trade. Next, we filter the call options by building the find short call option function to find the best candidate based on three things. First, delta, and second, strike price, and lastly, open interest. For delta, we aim for the range between 0.18 and 0.42 to maintain a balance between premium and assignment risk. And for strike price, it should be above upper Bollinger Band to ensure we sell calls at a strong resistance level, as well as avoiding unnecessary potential loss. And for open interest, it should be larger than or equal to 200 to help maintain liquidity. The way we built the find short call option function, it's quite similar to how we built the find short put option function, so we will skip the details in here. And once we find a suitable call option, we place a market order using the execute cover call function with Alpaca trading API. In this function, we use has sufficient shares function to check whether we already hold a specified number of shares for the underlying stock, in this case, 100 shares. After that, it uses the find short call option function to filter through the call options and select the most suitable contract. And once the function finds the best call option to sell, we place a market order using Alpaca trading API called market order request endpoint, which includes order size, order type, and time in force. After placing the trade, the function generates a success message confirming the cover call strategy. Now that we built all the necessary functions to execute the cover call safely, we run the function. Good. We successfully filter out the call option, find an appropriate one, and execute the cover call strategy. You can see the result. But we can also confirm the order was placed in Alpaca's dashboard as well. As we continue with the wheel strategy, we now have a choice: roll an existing position to adjust for market conditions, or close it and reset the cycle. This step is optional, but can provide flexibility in managing risk and collecting additional premium. Let's break down how it works. The roll rinse execution function automates this process based on whether we wanted to roll or close an existing position. The function starts by checking whether rolling is set to true or false. If rolling is set to true, we buy back the current option and sell a new one with a different strike price or expiration date. If rolling is set to false, we buy back the current option without opening a new one, exiting the trade completely. Regardless of whether we roll or exit completely, the first step is to buy back the option to close the trade. If it's a short put, we buy back the short put option. If it's a short call, we buy back the call option. This prevents early assignments if we wanted to adjust our position or take profits. If we choose to roll the position, we immediately re-enter the market with a new trade. Setting a short put, we open a new cash secure put using execute cash secure put function. If it's rolled in a short call, we open a new cover call using execute cover call function. This helps us adjust for stock price changes, volatility shifts, or assignment risk while continuing to collect premiums. If the function fails to find a suitable new position, it returns a message indicating that a re-entry was unsuccessful. This could happen if no options meet our delta or expiration or any other criteria. In that case, we may need to adjust our parameters or exit the trade completely. We applied a similar logic for rinsing and option cases as well. Now we also wanted to automate whether we should hold, roll, or exit a trade. This is where the roll rinse option function comes in. It automates this decision by assessing the trade based on delta movement, profit levels, ensuring that we follow our predefined risk management rules using just the one function. The roll rinse option function works in conjunction with roll rinse execution function to determine the next step for an open option trading. It follows these key steps: fetch the latest option price, calculate the current delta, compare delta to threshold, and check the profit target, execute roll, rinse, or neither. The first step is to fetch the most recent option price using Alpaca's trading API. Once we have the updated option price, along with the strike prices and the expiration dates of the sold options, we compute the current delta, as well as implied volatility. We also define our stop loss profit taking rules, which are delta threshold and profit target. For delta threshold, if delta has doubled from the original entry, it may indicate increased assignment risk. And for profit target, if the option premium had dropped below 50% of the initial credit, we may want to lock in gains. And now comes the decision point. If delta exceeds our threshold or profit target is reached, we call the roll rinse execution function to either roll or exit the position. If neither condition is met, we hold the position and re-evaluate later. After setting up the function, we run the roll rinse option function to check the option conditions and automatically rinse or roll the options. So at the time of recording this video, the function returned this output. The sold option price is still greater than 50% of the initial premium received, and the current delta is still less than twice the initial delta. Therefore, the function held the position and did not roll it. Now that you learned how to set up and execute an advanced option strategy called the wheel strategy, the next step is to put your knowledge into practice. We strongly recommend starting with paper trading or backtesting your strategy to fine-tune your parameters and evaluate its performance under various market conditions. This is a critical step to ensure you're fully prepared for live trading. If you're enjoying this tutorial, don't forget to subscribe to our channel and enable notifications so you'll never miss future strategy guides using Alpaca Trading API. You can also find more videos like this in our dedicated playlist, so be sure to check it out to further expand your knowledge. Lastly, please review the important disclosures in the description below before starting your trading journey. It is essential to fully understand the risks involved with both trading and algorithmic trading. Thank you for watching, and we'll see you in the next video.